Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently one of the subscribers or one of the community members asked me to look at this company, and this is a dividend king. So today we're going to talk about a dividend king, and a dividend king is a company that have been paying its dividend or increasing that dividend for over 50 years. Think about this. For 50 years this company has increased its dividend every single year without fail. And the reason they do that is because, of course, they have some excess money lying around, and after they've basically paid their commitment and they've taken care of their financials, they then pay some of that basically net income or some of that free cash flow they have to their investors, which is quite nice to see. And they made that commitment for over 50 years, especially with this company, over 60 years of increasing that dividend. So we're going to look at the company. We're going to just go talk about briefly what the company does, and then we'll look at the financials, and then at the end we will see if this company is undervalued, overvalued, and so on. Now, if you have any companies that you are thinking about, just put it on the comment section, inshallah, then I will get to it. I've not been looking at the comments lately because I've not had the time, I'll be honest with you guys. So yeah, just have a look at it, just put it down there, and inshallah I will look at it in the next couple of weeks, inshallah. Right, so the company we're talking about today is in consumer discretionary. That means they have a product that is not in demand straight away, of course, and it's a hit and miss when it comes to some of their revenue, so it can fluctuate their revenue, and we will see that in a bit, inshallah. But before we do all of that, just do me a favor, press that like button, subscribe to the channel, because it takes a lot of time and effort to put these videos together. And the most important thing for me as well is liking the video, subscribing to the channel, is also join us in the Patreon account, where you get access to a lot of the buys and sales and watch list. You get access to the private Discord where a lot of brothers are sharing good practices. On top of that, you get the Sharia compliant investing ebook, and especially if you're new, this can help you, inshallah. And of course, as always, if you don't want to do any of that, just subscribe to the channel, and that's the most important thing. And if you end up joining us here, it will cost you only 15p per day. Now, let's talk about the company. The company is Genuine Parts Company. So this is a request that came from one of the brothers in the community. And straight away, one of the things that you will see is for the 1 year is actually down about 2%. This is one of the companies that's basically what they do is they sell products that's needed more or less still in this world right now we live in right now. So the company distributes automotive replacement parts for hybrid and electric vehicles, trucks, SUVs, buses, motorcycles, recreational vehicles, farm vehicles, small engines, so on. So it's one of those companies where if you own a car, some sort of a vehicle, and you need some parts, you will go to and buy it. And of course they are based in the US, but they do have other some of their parts are sold around the world. So now let's go back. So now we know what the company does. Let's go back to the financials and look at year to date. It's actually up about almost 16%. In the last 6 months, it's up 24%. And just this month is about 4%. So it hasn't done bad at all. In the last 1 year, so we're looking at about minus 2%. In the last 5 years, we're looking at 54%. And in the last basically 10 years, 87%. But just remember, this is just the price, and we will look at that in a second. Now, so the company has a market cap of $22 billion. So they're not a huge company, and they have an excellent dividend of 2.5%. And that dividend is actually safe, 80%. The highest anyone can get is 99%. But as you can see here, it's about 80% right now, which means it is safe. Now, looking at the payout ratio, it's only 44%, and dividend streak of 67 years without a reduction. So 67 years of basically without increasing that dividend. Latest increase was 5.3%, and that was February this year, and 6% in the last 5 years, and the last 20 years about 6%. So they're growing it, but it's not growing really as fast as you would have liked. But 67 years basically of consecutive increases, and this is what makes this company a dividend king. Now, you get $4 for every share of this company that you own, so that's the payout ratio. And looking at this right now, it seems basically reasonably valued, because the 5-year average is 2.7. Right now, we're looking at about 2.5. So it's not undervalued. It's kind of reasonable. And when you look at basically the forward PE, you can see 17.8, and in comparison to 15.9. So based on the forward PE, is actually trading slightly lower than where it has been over the last 5 years. So and basically the consumer discretionary right now is about forward basically they have a PE of 14 right now. Now looking at the earnings payout ratio, we have already seen it's about 41. Next year it's actually going to come down even better, which is 40%, which is fine. Free cash flow payout ratio of basically this year is 53. Next year is going to go up about to 70%. Earnings per share, as you can see, was growing really nicely, kind of flat around here, then it's gone up a little bit. It has come down 2020 because of COVID. Since then, it's actually been growing nicely, and as you can see here, every single year for the last 5 years it's actually been growing really nicely. Free cash flow per share also has been growing, apart from 2020 where we've seen a massive increase, and then it has come down quite a bit since then. Now shares outstanding, which we actually like to see it declining, is absolutely declining over the last two. As you can see, since 2014 they have been buying back their own shares. One of the reasons I love the companies that buy back their own shares is that's one way of course giving something back to the shareholders, because now if you own of one share of this company around here, okay, then by now your share is worth more because there's less shares out there. Does that make sense? So I hope that kind of makes sense. So buying back their own shares is really good. The only time I hate companies buying back their own shares is when the shares are too expensive and the company starts using some of their free cash flow to buy back their own shares. That I hate. But when they are buying back their own shares, especially when the stock is trading really basically cheaply, then of course it's important. Total sales. So now we're looking at the revenue or sales, whatever you want to call it. 15.3 in 2014. Every year has kind of been a little bit increasing here and there. And then we've seen a little bit of decline in 2020 because of COVID, and then it's bounced back again. And right now we're looking at basically about 23.1 from $15.3 billion over the last 10 years. Now, return on equity, we're looking at about 30%. Normally for this type of companies, we're looking at about just 10%. Okay, anything above 10% is really good. So 30% return on invested capital. Again, these two help us to understand how the management is actually using the money that we're giving, or basically the capital they're getting from investors, from banks and so on, and what they're doing with that. So the company to gauge management's capital allocation skill. So if this is high, then that means the company is doing good job with basically the money that they're getting from investors and so on. So the next thing is the operating margins, and as you can see, it's about 8%. Normally we're looking for about 12%, so it's slightly lower than what we want it to, where we want it to be. And free cash flow margin, we're right now looking about 4%. That is actually basically a it's basically flat for the next couple of years, basically for the next 12 months. But yeah, so 5% is what we're looking for, about 4% right now, so not far off. But as you can see here, 2020 was actually a good year in terms of these margins, but since then it has declined. So net debt to EBITDA right now, we need about 3. Right now we're looking about basically below 1.44. So 1.44, anything below basically 3 is perfect, and that's very good to see. And now going back to Seeking Alpha, we're going to look at some of the basically expectations moving forward for this company. So first we're going to look at the earnings estimate, so to see what these analysts are expecting. So there's about 13 of them looking at for next 2 years, this year, next year, and then 5 of them are looking at in 2026. So as you can see here, it's about 6%, almost basically 9%, and then 6.5% for the next year. So which is fine, because this is the type of business, steady Eddie kind of growers. About you grow, you're getting about 6% to 10% every single year. In terms, they're growing about 6 to 8% or 10%. If it's a good one of those companies that have a product that's in demand and so on, of course you will get about your 6% to 10%. So this seems actually good. Next is the revenue side of it. So you can see 3.16 and then about 5% for the next couple of years. So nothing huge, but nothing to worry about either, because that's how they've been growing. And like if we now look at the growth side of it, the last 5 years, so if we compare, basically look at where they were last 5 years, we're looking about the revenue side of it is about 7.6. So it's been around basically it is around where it has been the last 5 years. And using the EPS diluted growth basically forward, if we look at the 8.55, which again is basically similar to what we've just seen at the expectations. Now looking at Yahoo Finance, as you can see, the growth estimate for the next year is about 8.5%. After that, 7% every single year. So they average it out and they tell us per annum, this is what they expect in the earnings to grow, which is absolutely perfect. And like I said, this type of business, that's what you would expect anyway. Now looking at valuation side of things, so if we first go to Morningstar, as you can see here, they are 3 stars right now. That means they're fairly valued right now. $150 per share is where the price should be, but right now it's 162, so it's slightly higher, heading towards that overvalued territory. But it might actually, if we see a decline in the overall market, it might come back down again. The economic side of things, or the mode side of things, is narrow economic mode. And looking at the trailing return, so basically looking at the total returns from this company in the last 10 years, about 8.3%. And moving on to Seeking Alpha, just to see what Wall Street's saying. Again, by the way, Quant is actually saying it's a buy, the stocks is a buy, Wall Street is a buy, and Seeking Alpha is also, analysts are saying it's a buy. So Seeking Alpha, according to Wall Street, it's 3 strong buys, 1 buy, 10 hold, and no sales at all. And it's about 3%, 4% upside from where we are now, $166. So nothing to worry about, but then nothing to also get excited about at the same time. Now looking at simply Wall Street, as you can see here, it's about 25% undervalued. They are quite bullish in this company. $215 per share is where they think the price should be. And in terms of growth side of it, as you can see, it's about that 6%, 7% that we've already seen, so nothing huge there. Now looking at the valuation, so we combining things together in here. So we've got the Morningstar valuation, we've got Seeking Alpha valuation, we've got Simply Safe Wall Street, and then discounted cash flow model that I used, as well as the dividend discount model. All of that has given us about, on average, $168 per share. So the average intrinsic value for this business is about $168 per share. And again, please do your own research and don't rely on this. Again, I'm just using, of course, these analysts and what they came up with, as well as basically using my own discounted cash flow model, as well dividend discount model. So that has now the price is right now let's call it $160 per share. That's gives us about 5% upside from where we are now. But then if you say, do you know what, this company, I don't really know much about it in terms of basically moving forward, I'm not sure how things are going to go. And as always, it's good to have a margin of safety. So if we say that our margin of safety for this company is about 5%, okay, that's $160 per share. But then you might say, do you know what, I need a bit more than that, 7%. So I'm going to wait until it hits 156, or even maybe 10%, and then wait until it hits 150. It's not far off, to be honest with you, from where we are right now. That's about $8 or $9 from where we are right now. So yeah, so that's the company that I want to share with you guys. And in terms of Sharia compliance side of things, nothing to worry about. But in terms of interest bearing debt, it's slightly higher, so it might be heading towards that 33% or 30%, whichever you want to use. But overall, it seems a good company. So what would I do if, I don't own this company. I've talked about it before. I don't think I want to own it because I do have some companies that are very similar. I do have Cummins, and Cummins, I know it's industrial, but it kind of reminds me of Cummins, and I'm actually happy with this one here. And I don't want basically a lot more kind of slower growers, because I do have some of those in my portfolio, as well as, of course, the high flyers. I've got those, but I want to make sure that I don't own too many of those, because that can affect your performance overall. But if you're looking at foundational stock that is like, dividend paying company, a reliable dividend every single month, and you have a place, basically it might have a place on your portfolio. But right now I'm just going to pass. And of course, if you've got any companies you want me to look at, let me know, inshallah. If you haven't joined us in the Patreon account, please do so. If you have not liked the video, please do it as well. It really helps the channel. Assalamu Alaikum.